Okay, we're just going to round out the series here with how I think the multi-year cash flow should be finished off, and that is just with a net worth. So all you're going to do here to get your net worth, you're just going to total up all of your assets minus all of your liabilities. So we don't have that many assets, or that many liabilities for that matter. We can go to the RRSP. So you got an RRSP balance. I better grab the year one RRSP balance. And we've got a TFSA. And we have some debt. We have a mortgage. And we have a credit card. And that's it. So I just do that very simple bit of math, RSP amount plus TFSA amount minus mortgage amount plus the credit amount, all in brackets there, so that's all okay. And just hit enter. So that shows my net worth for that year. I don't have the value of the house in there, so that's why it's negative, but it's still the same concept. It doesn't really matter. It's just a formula. And then you can just copy that formula all the way across, and because it's all age-based, it'll just copy out relatively neatly. Should have no problem. Nice big number down here. So we have, I can't remember where this went wrong. The credit card is all funky over here, but that's fine. It's still the same idea. It's a net worth statement, and you're just adding up those numbers. That's all. That should wrap up your statement for you. Very easy to do. Just all of your assets minus all of your liabilities. If you get something like I have here, which is clearly not right, you know, you've forgotten something, and you would go and build a tab for the house. And you would just throw the house in here. And whatever value the house has to start. And you might even start that on your data sheet where you say value of home. And maybe we start this thing off at $320,000. And take our ages here, base that on our age on our multi-year cash flow. Copy that all the way across. Take the house value and just like so, and then we're going to just take that and we're going to inflate it. So we've done this 1,000 times. Times 1 plus, and we'll take inflation off of our data here. Assume we're using house inflation. We'll make that an absolute reference, same as all other inflation, and just copy that all the way across, and we can see the value of the house increasing here. And it's going to end up at some large number, and now with our multi-year, we just have to go back and adjust our net worth, where we're going to bring the house into the calculation. So we just go back to the house here, grab that number, and add that in, and that should fix it so that we at least have positive net worth in those early years. Still going to be messy out in the later years because building credit card debt as we have a cash flow surplus in retirement, but the idea is there. Good, and that should be the last thing you have to do to round out your multi-year cash flow statement. That really is part of the estate planning portion for the purpose of your competency profile, but doing it right now makes all the sense in the world.